Lennar just hit an all-time corporate record for how fast they can build a house, but their net income still somehow cratered by 56% year over year?
Yeah, well, building them fast doesn't really matter if you have to, basically bribe people to buy them.
That is a brutally blunt way to put it. But welcome to Earnings Unscripted, everyone. It is March 13th, 2026, and we are unpacking the Q1-26 numbers for Lennar, which is one of the massive, heavy asset home builders out there. And just a quick note before a bureau completely dismantles their balance sheet, everything we talk about today is just our personal opinion, definitely not financial advice, so please don't base your life savings on our banter.
No, definitely do not do that, especially since even Wall Street couldn't figure out how to trade this report.
It was a total roller coaster.
Right, so the stock dumps hard in extended hours yesterday after the print. It hit a volatile low around 89.50, but then by the time pre-market opened today, all of that fear was just gone. It completely reversed and actually opened higher at 95.32.
Which is wild to me, because when you look at the top line numbers, they are genuinely not pretty. Revenue came in at $6.62 billion, which is a 13% drop, and earnings were 93 cents a share, down from $1.96 last year.
True, but the market was already pricing in a lot of that pain. The metric they really care about right now is the gross margin on home sales. That squeezed down to 15.2%. Down from 18.7 last year. But management came right out on the call and said this is the absolute trough for the year.
They called the bottom right there.
Exactly. And it takes some, either confidence or desperation to draw a line in the sand like that. But I actually buy it on the operational side. They managed to drop direct construction costs by another 2.5% this quarter.
Which brings us back to the speed record. The whole stopwatch wars anecdote on the earnings call was so funny to me. You literally have these regional presidents trash-talking each other over build times. Like Greenville built a house in 96 days, so Charlotte is trying to beat it next quarter.
Right, the gamification of drywall.
Exactly. But it is working. The corporate average cycle time dropped another 5 days to 122 days. That is an all-time low. But then you zoom out and see they're giving away 14.1% of the home's value in incentives. It kind of feels like they're pedaling furiously on a bicycle that's stuck in the mud.
No, I look at it differently. It's a shock absorber. With mortgage rates glued above 6.2%, affordability is just broken for the primary home buyer. So Lennar is deliberately giving away that 14% to buy down interest rates and keep people from walking away.
So they take the hit today just to keep the product moving.
Basically, you don't want stranded inventory sitting on the balance sheet in this kind of macro environment. It bruises the margin, absolutely, but it keeps their cash flow turning over.
Wow. Okay, let's get into the details of how that strategy is actually rippling through the rest of the company, especially what it's doing to their financial services arm.
Right. So the financial segment is where you really see the actual cost of this affordability crisis. Operating earnings there dropped to $91 million from, I think, $143 million last year.
Just because volume is down or what?
No, they are still originating loans, but because consumers are so squeezed by that 6.2% rate, they are abandoning fixed rate mortgages entirely. They are flocking to adjustable rate mortgages, ARMs.
Which are just inherently less profitable for Lennar to originate, right?
Exactly. Diane Bessette, the CFO, called this out. Lower lock volumes, lower profit per loan, and a massive product mix shift toward these lower earning ARMs. It is basically the collateral damage of keeping the home building volume up. You squeeze the mortgage arm to save the builder arm.
Okay, but wait, if the consumer is this stressed out and stretching into arms just to afford a house, why not just sell more volume to the institutional guys, the corporate landlords? They usually buy, like 5 or 7% of new homes?
Well, that is the other shoe dropping. And this was genuinely the most fascinating part of the call to me. They cannot rely on those buyers right now. Stuart Miller was very direct about this.
Wait, because of the pushback against Wall Street buying up neighborhoods?
Right. The political headwinds are getting intense. Miller actually said, and let me make sure I quote this correctly, he said the institutional purchasers have been sidelined by political pressures and popular sentiment that suggest that they are part of the housing problem.
Wow. Okay, so basically public relations is literally deleting 5 to 7% of aggregate housing demand overnight.
Yes, and that fundamentally changes the macroeconomic math for builders like Lennar. Sidelining the corporate landlords means Lennar is forced to push almost all their volume exclusively to those financially strained primary home buyers, the same ones who need the heavy incentives and the lower margin arms.
It's a feedback loop. Like they're trapped pushing incentives because the safety net of the institutional buyer is just gone. That's wild.
Which is exactly why they're obsessing over cycle times and automating everything else. If your gross margin is getting compressed to 15% and your financial services arm is taking a hit, you have to find margin somewhere else.
Right. So where do they find it? I mean, construction costs are already down.
SG&A, sales, general, and administrative costs. They are practically turning into a tech company. Have you seen the stuff they are doing with Tiger Eye?
Oh, yeah, the AI agent thing. I saw David Grove talking about dropping lead response times
to 35 seconds.
Geez, 35 seconds.
Right, 12% improvement quarter over quarter. They have these digital agents running 24/7 trying to catch every single stretched buyer the second they show interest. It is almost like a SaaS customer acquisition funnel grafted onto a lumber operation.
I mean, if you have to fight for every single individual buyer now that the institutions are stepping back, it makes sense. But didn't Stuart Miller also say something about finally paying the dumb tax on their tech rollout? I loved that phrase.
Yes, the dumb tax. So they spent 2.5 years migrating off this legacy world ERP system onto something called E1. And Miller said they have already paid the dumb tax embedded in learning and unknown disciplines, meaning all those expensive consultants, all that friction, it should be rolling off now.
Should be. But wait, I think I saw their SG&A as a percentage of revenue actually ticked up this quarter to 9.8%.
It did, up from 8.5, which is the slight catch here. Management promises the heavy tech consulting costs are expiring, which should trigger overhead relief later this year, but we haven't actually seen it hit the bottom line yet.
Right. It's still a promise at this point. They built the shiny new engine, but we're waiting for the actual fuel savings.
Pretty much. And if the spring selling season is soft, they are going to need those savings badly, especially with that much cash locked up in inventory right now.
So basically, they're squeezed on margins, fighting for single buyers with AI, and hoping their massive tech investment finally pays off to offset the affordability crisis. It's a lot of moving parts. So where does this actually leave them heading into the spring quarter?
Well, it leaves them basically doubling down on their own execution. They are projecting around 20 to 21,000 deliveries for Q2, and the big thing is they expect that bruised 15.2% gross margin to tick back up.
To what, though? Like a massive recovery or just treading water?
No, just to, actually, I think it's 15.5 to 16%. But management is adamant this quarter was the absolute low point for the year.
Right. I saw Stuart Miller talking about that. He had this whole bit about how when mortgage rates finally normalize, pent-up demand is just going to flood in and their margins will recover rapidly. Which is great, but what if rates don't normalize anytime soon?
That is exactly the risk, and you can see they know it. During the Q&A, an analyst called out that they essentially used $1 billion in cash flow this quarter just building up inventory.
Wait, $1 billion? I thought the whole point of their asset-light strategy was to not trap capital.
It is, but the model only works if the homes actually sell at the pace you build them. If this spring selling season turns out to be a dud, all that capital is just sitting there in the dirt.
Which is probably why Miller spent so much time talking about geopolitical risks on a domestic homebuilder call.
Right. He threw out this massive caveat about the Middle East conflict, saying, quote, it might trigger higher gas prices, higher inflation, and higher interest rates, and we'll just have to wait and see.
Yes, the classic CEO safety net. We are executing perfectly, but if we miss next quarter, please blame global macroeconomics.
It is beautiful, really. But look, to be fair to them, holding an 85,000 home delivery target for the year in this rate environment takes guts. They are placing a massive bet that they can manufacture their own demand.
Yeah, it feels like they're stitching the parachute while falling. It is going to be a very telling summer for them to see if that dumb tax they paid actually turns into smart money.
I will certainly be checking the math next quarter.
I know you will. Well, that is all the time we have for today. If you want these episodes to just show up in your feed, go ahead and follow the show. As a reminder, this podcast is built with AI tools, which is exactly how we instantly process those giant SEC filings. We want to hear your ticker requests, so email us at earningsunscripted@datamadness.ca or use the X link in the show notes. Thanks for hanging out, and we will see you next time.
Take care, everyone.